Hey everybody, it's Greg Rice. We're here in the Bucket, Pawtucket, Rhode Island, and today we're going to talk about the rising interest rates. The interest rates are going up, so what does that mean for you and your future as an investment property owner? So it's bad news whenever you hear rates are going up. However, there is some good side, some optimism that I'll talk about later in the video that can happen with the rising rates. So first off, we want to look at the last 2-3 years. The rates have been artificially low, very low, 2%, 3% for investment properties. That's crazy. But conversely, the prices have been climbing. So you're spending double what you were on the same property 5-6 years ago, right? So let's look at today. The most commonly traded unit is going for about $100,000 per door. So if you're buying a 4-family, you're likely to spend $400,000. 5 years ago, that number was $50K per unit, so you'd spend $200,000. However, the rates were high back then. So today, I got my little cheat sheet here. Rates are in the fives, guaranteed. If you're an investor, you're in the fives. I think they will reach 6%. So let's look at two examples. You're buying a $400,000 property, 4 units. The price today, like I said, is about $100K per door. So you're spending $400K, but you got to put down 25%. So you're putting down $100K, which is a lot of money, but your mortgage is only for $300,000. If your interest rate is 6%, your payment would be $1932.90. Okay, at 6%. Conversely, say a year ago, rates were 3%, for example. That same mortgage would be $1422.63. So the difference in just 3 points there is $500 a month. $500 with that higher interest rate. That's $6,000 a year. That now you're going to have to be able to come up with to make that mortgage work. So can you raise rents that high? Can you raise everybody's rent by $200 to offset the higher interest rate? Potentially. But what's going to happen is we're reaching a point where that is getting unsustainable. So if the tenants can't afford the rent, they're moving out, you're evicting them, you can't fill your vacancy for a couple months, then it's going to naturally regulate itself. So what will happen, I feel, in this market is once the rates tick up, and they are right now, the demand will slow down, which in turn will slow down the rise in prices, and we might start to see that curve come back down. So in 2016, for example, I remember having a 5.5% interest rate, but I was only spending $150,000, $200,000 for a 4-unit property. So I don't think we're going to go that low as far as the prices, simply because the rents are much higher. They're about 50% higher in the last 5 years. So I feel like we're going back to maybe $300,000 or $325,000 for a 4-family property. If the rates stay where they are, the demand, as well as the rent rates that we're getting here in the Rhode Island market. So that's how it's going to affect things. Your prices, your mortgage are going to go bananas, so you're going to have to offset that by increasing your rental amounts. But in turn, tenants are going to expect better conditions for those higher rent amounts. So be prepared to invest in flooring and counters and cabinets, appliances. You can't ask $1,300-$1,400 for some slummed out 1-bedroom unit. Okay, tenants will be able to find the nicer amenities that they're going to get the value for their dollar. So if you have the 1980s wallpaper apartment and you're asking $1,300, the tenants won't agree with that. The market won't agree with you. That's going to stay vacant, or you're going to get a poor tenant that just needs to move in and have an eviction on your hands in 3 months. So my point there is you're getting a nicer, higher rent for sure, but you also need to keep pace with the market and keep things nice, neat, and clean. Okay, so if you have any questions, I try to boil this simply down as possible. Any questions, let me know in the comments field below. Once again, Greg Rice here at Nexus Property Management, your property managed.